Hello everyone, welcome to today's US Open live webinar. It is Thursday, December 7th. I'm your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. We had a delay there at the beginning. In any case, USD JPY is today's main mover, losing around 1.5% on renewed hopes for a hawkish shift from the back of Japan, amidst anticipation for cuts by its US peers in an unfavorable differential. The European economy, meanwhile, unsurprisingly contracted in Q3, boosting the case for peak rates by the ECB, while US employment data add to from today and over the previous days add to this easing labor conditions narrative ahead, of course, of Friday's NFPs, which is the week's main event. Before, however, we begin, as always, please read carefully through the risk warnings and the disclaimers. Okay, let's get the ball rolling. We're gonna start today with the Japanese yen, which is the main mover, as we said. Then we're gonna talk about Euro USD, and then about the Nasdaq, which finds renewed support today. And we'll run things off as always with what's ahead, including Friday's NFPs and the CPI inflation update from the US at the beginning of next week. Now, on the USD JPY front, the pair slumps today on markets hopes for a pivot by the Bank of Japan, which has been an outlier, maintaining an ultra dovish stance with negative rates and yield curve control as it tries to create a virtuous wage price cycle. It has been taking steps towards normalization by loosening its grip on the yield curve, but has not shown any intention for immediate changes. Today's comments by Governor Redham continue to point to offer hints, or at least markets perceive it as such, as a change in policy, as he talked about options after an exit from negative rates. It may still be early for a shift, but the bank surprised last December with its first widening of the yield curve, and could make a sudden move again, because telegraphing a change well in advance would partly beat the purpose. Like if they decide to drop the yield curve control altogether, for example, there's not much point in communicating that in advance, as it would, as markets would attack the threshold immediately. The US Fed, meanwhile, has slowed down the pace of tightening as it gets closer to targets, and market expectations have been reinforced by recent data, and they price rate cuts within the first quarter of 2024. We have repeatedly talked about this divergence and how a change in the dynamic could lead to a sharp repricing in USD JPY, which has rallied because of that differential. And we're already seeing the first signs of such a change in dynamics in this month slump. The pair runs its fourth straight losing week after narrowly missing multi-decade highs last month. This exposes it to the 38% Fibonacci of the 2023 rally. On the other hand, markets hopes for pivots by both central banks may be overly optimistic, while the move is stretched technically. The green pack tries to catch a breath close to its just above its September lows, and we could see a rebound, but the upside remains hostile. So even though we could see a rebound, that would be limited. Of course, there are key events coming up that will shape the pair's movement. So definitely caution needed there. Now let's turn to Euro USD. It stays on the back foot on policy differential fluctuations. The ECB has made more progress on inflation, has hinted at peak rates while the economy struggles, as confirmed by the Q3 contraction announced today. This as we discussed last time, this backdrop makes a more compelling case for a pause and a start of cuts. Markets expect the Fed as well to cut, but the economy there is very strong and inflation still above 3%. So definitely a better candidate for a pivot is the ECB as things stand now. In any case, this pivot exuberance seems a bit stretched to me. The pair breaches a pivotal support area, which we highlighted last time as well, which exposes it to the daily Ichimoku cloud, which starts around 1.07. However, the RSI points to oversold conditions. We're already seeing trying to exit such condition on the bottom of the chart, and we can expect a recovery here. Already the pair finds support today. The November highs, though, at around 1.1017 look distant, and once again we have the NFPs on Friday, the CPI, the US CPI next week, early next week, and then the policy decisions by both the ECB and the Fed. So caution is needed. Now let's talk about the Nasdaq 100. Recent data have raised the bar for more hikes by the Fed, as we talked about, and this week's employment statistics point to offer more signs of a loosening in the labor conditions, including today's releases. Markets and which reinforce prospects of a pivot, and that's why we see a lift today in the index. Markets pricing 125 basis points of cuts in 24 to begin in March. Such prospects led to new 2023 highs last week and have opened the door for the record highs at 16,770, but this still looks distant. However, we have seen an easing, a consolidation of after the 2023 peak, as markets seem to adopt a more wait and see approach ahead of the key events that we already mentioned, and we're going to talk a bit more in a bit. The Q1 rate cut anticipation seems too much, and with the bar so high, hopes can be easily disappointed. It's unlikely that the Fed will point to rate cuts, and definitely not as fast as markets expect, as early as markets expect. This pullback that we see this week, although very limited and contained, does create risk for a test of the 200 period DMA at 15,580, which could endanger the bullish momentum, but strong catalyst would be needed for sustained weakness below it, and there are multiple support areas below it. Now, what's ahead? It's the US jobs report on Friday. Although the labor market is still tight, it is moving into better balance. This week's data ahead of Friday's report added to this narrative. Now, in terms of the last NFPs report, it had shown the addition of 150K jobs in October. That was the weakest print in nearly 3 years, but it was also way impacted by the auto workers strikes, which have now ended. Baseline's expectations are for a higher addition of 195K jobs for November. Next week is dominated by the central bank bleeds, Bank of England, European Central Bank, and the Fed, but these are in the second half of the week. It starts with the UK labor data. Wage growth remains historically high despite some moderation, and the government's 10% hike in the minimum wage to begin in April can accelerate those pressures. And we also get the US CPI inflation update on Tuesday as well. US inflation has decelerated and moves to the direction that the Fed wants, but remains above 3%, and it is still far from the Fed's target. That's it from me for today. We will talk again next week on Tuesday at our usual time slot, 10 minutes before Wall Street opens, and we're going to talk more about the looming central bank decisions then. Thank you for joining.